Good morning, everyone. It is 9 a.m, so we will get started. Welcome to today's Audit and Risk Subcommittee meeting. It is my first one since the roadworks outside has started. I hear that you're all used to it, so yeah, I'll be getting used to it today. So hopefully we can all go all right in terms of talking with the sound outside. All right, I'd like to welcome everyone with the karakia. Tūtā mai I runga, tūtā mai I raru, tūtā mai I waho, tūtā mai I roko. Kia tau au ngori tū, te ngori ora kia te katoa. Umie, huie, tauhie. Just to remind everyone, we are now live streamed. That's all now live. Apologies, everybody is here, so we have none. It has to see. And public forum, we did actually have somebody tell us that they would like to talk today online, and they haven't joined yet, but we will just keep an eye out for them, I think. So we did have one public submission, someone asked to talk, which was good. All right, confirmation of the agenda. I've not been notified that anything needs to change, so that is looking fine. Declarations of interest, just remind everyone to stand aside if there's any conflict that arises during the course of the meeting. Confirmation of our last minutes. If everyone would like to have a look, or if they have done so already. First by Kate, seconded by Tim in favour, against, passed, carried, thank you. Open actions. So on our action register, we do have 2 items. We're just going to look at those again. The first one, which is just our item there on internal audit, which we're just keeping there to remind ourselves, co-chairs of the committee, to work with the chief executive to commence the internal audit program. We have had progress on that. So I'll just confirm that is, we're just going to keep that one open.
Yeah, so we can, sorry. So we completed that first audit, and then we are just awaiting some resourcing in Amanda's team to go out to tender for an ongoing internal audit program. So we'll get a consistent supply for the balance of them, but the first one in terms of the asset management is being picked up by Tom, mainly in the engineering space.
And so the second action is referring to that engineering space one, which is that we request the staff consider the recommendations as part of the overall business improvement program. So just on that.
Yep, so that's included. Most of those recommendations related to asset management in the engineering space, however, they are applicable in some of our other areas. So as well as being overseen by Tom and Brett, they'll be picked up in the wider business improvement program we have running, which picks up all the actions from the efficiency review and the other reviews that we've had undertaken. So that regular reporting on that business improvement cycle will pick up those.
So should we possibly close that one if it's now being pushed?
I think the second one can be closed, the first one should remain open.
Okay, great. Great. All right, so that's the action register. The first one will remain open. The second one can now be closed. All right, so we'll go back to our public forum.
Oh, kia ora, thank you.
Welcome you, Adam. Thank you for asking to talk today. We've just started the committee meeting, and so it'd be great to hear from you.
Kia ora, koutou. Thank you so much for hearing from me. I'm Adam from 350 Aotearoa. He worked on climate campaigning. I wanted to talk to the committee about 2 things today. I mean, the first was to extend your ethical investment policy to coking coal as well as thermal coal. And the second was to urge you not to do the put the 5% in private equity, given how we know this is going to undermine the responsible investment policy. So look, I'm not going to talk about the importance of divestment and what it means. And I think, you've gone over this in detail, and I'm happy to go into this if there are any questions. But we obviously know that if it's wrong to wreck the planet, it's wrong to profit from that wreckage, right? And same with all the other classifications of divestment as well. And very, very clearly in that presentation a couple of weeks ago, and also very, very clearly in the documents, it shows that that if the OIC does choose to go with option A and choose to put 5% into private equity, that we don't know what would happen to that. Yes, there may or may not be some responsible ways to invest it, but it will end up completely outside of OIC's control, and it could very likely result in in money being invested in weapons, money being invested in climate change and fossil fuels, and some of the other investment categories as well. And while there are obviously some responsible investment options, it is different to your own policies. And the options paper also didn't clearly say, okay, look, we are only going to put that private equity in X fund, which we've already assessed for responsible investment against our own criteria. And so I think it's really clear, and we've seen this in other councils, we've seen this across other investment classes across the country, that as soon as you put that a couple of percent into private equity, that money is lost, and that money is effectively gone into things you don't know where it's going to go. Part of that, and I also think it's yes, it might be a very small portion, right? It's very likely that if you put 5% into private equity, any money invested in hypothetical fossil fuels or whatever is going to be astronomically low. But it's the principle that counts. It's a principle that counts, and also you can easily put that 5% into put it back into the other 3 equity classes, as option B says. You could put it into anything you could do with that. You can put it in the property, you can put that 5% anywhere you want. There's no need to put it in this 5% private equity, because it would really undermine the ORC's climate commitments. It would completely undermine what the Otago Regional Council was doing on climate, for what. And I also I can talk about that. I've got much more details on that, if happy to go into if wanted. But the other point I also just wanted to note was I would encourage you to expand the your overall responsible investment policy to coking coal, which is obviously quite a clear and it's missing from the policy at all, including oil, gas, and thermal coal. And we know that New Zealand steel, for example, is already getting out of, is phasing out of much of its coal use already. And we're also seeing that coking coal mining across the world and in New Zealand is increasingly losing its social license and being seen negatively. Many of you will have heard of the Denniston coal mine proposal in near Westport, where a lot of us, we climbed coal carts. We shut the mine down for 3 days, and we camped on the proposed mine site for a week, because this is for example, that's a coking coal mine on Kiwi habitat, blah blah blah. And we're seeing all sorts of coking coal mines across the world and in New Zealand, incredibly irresponsible, incredibly risky, incredibly environmentally destructive, all for what we don't need. We know that we're already transitioning steelmaking away from coal, so it's a really, really staring us in the face exception to the OSC's responsible investment policy. So yep, I'll just encourage you to make those 2 changes if possible. Kia ora.
Thank you very much, Adam. Appreciate you taking the time to talk to the subcommittee.
All good.
Does anyone want to ask him any questions? No.
I'm still here if there's questions. Yeah.
Does anyone want to ask any questions at all? For Adam? All right. Thank you very much, Adam. Appreciate your time.
Kia ora.
All right. So that brings us to the first item of the agenda. Item number 9.1 is our Treasury report. So we have Nick coming. Well, Nick, would you like to give us a brief overview of this of the report, which is a standard agenda item for us, but a good one that we need to look at?
Yeah, it's not on, is it?
The music has died outside, which is great.
Yeah.
Oh, Gone now. No, it's on.
Is it on?
Yeah.
Yeah, red light's not on there.
They're both on now.
Plus,
Both
okay.
on.
Plus,
The yellow flag.
They're just warming up,
It's
yeah.
the Merville down there.
all right,
Yeah.
doesn't sound like it's working, or is it?
Now press it. Yep.
Okay, there we go. Right. Yeah, this is just the standard treasury report. So this part of it comes from, it's got the Bancorp report attached that outlines our debt. Most of the focus is on OSC's core debt, which remains at 25 million. Does also just outline the amount of total debt that we've got with the port on lending as well, which their lending is 127 million. So everything's compliant with our treasury policy and our LGFA covenants. So really, it's just for the information of audit and risk.
Thank you, Nick. Any questions?
Nick, I'm just, I was looking at this graph on 17 of 105 pages, the interest rate risk management, and the graph that it's the line graph. Just can you explain it? It looks like it needs some sort of explanation.
Which one? The bottom one?
Yep. One of the red lines and the blue lines, and the sort of the big gap, and then they're coming together.
Yeah. Well, the cost of funds, the red line is what we've actually got in place. So that's what our interest rates will be based on the debt and swaps that we've got in place, and the blue line is the market linked rate, which you can see is going up. So at the moment, our cost of funds are above the market rate, which is the floating rates, yeah, but they come together in 28. And then, as you can see, we've got them roughly, they move around a bit, but you're trying to keep those two lines relatively in sync.
So what's brought about the change that we see here? Because it's reasonably significant. The blue line, March 25, is significantly less than the red line.
Yeah, because we've got the blue line's based on on your current market rates. So it's based on effectively on your 90-day bill rate, which is floating, whereas our red line is based on our actual cost of funds, which has fixed debt in there. We've got two of our tranches of 5 million are fixed. And when we fixed them back when we started a couple of years ago, rates were higher. They then dropped significantly. You know, as we've seen over the last 12 months or so, rates have been dropping. So that's a reflection of where our current debt is at, because we locked it in sort of 18 months, 2 years ago, and where the market has now dropped. But over time, the two will come back together.
So if we were to mark to market, which we had to do on these sorts of things at the financial year end, will we be showing a loss?
Not on the loans themselves, but on the on our swaps.
Yeah.
We basically get a mark to market report or update every month, and there'll always be an adjustment for what the swaps what their current market value is, and yeah, we just take that through to the P&L. Yep.
Thank you.
Kevin and then Kate.
Yeah, on page 11, and then that whole report on the Bancorp Treasury reporting. So if I understand the purpose of that report, but is it we have our sets, our treasury policy. So is it mandatory that we have this report from Bancorp, and why can't we do that in-house? And also, what is the cost of this annual cost of this report?
So no, it's not mandatory that you get this, but we use Bancorp as our treasury advisor. So we pay them a monthly retainer so that we can just tap into them and get investment advice as and when we need it. Like always talk to them about whenever loans are due to roll over, talk to them about the timing of what we should borrow, how we structure the debt, everything. So we've got them that we've contracted them to provide that advice. So as part of that, they provide the reporting dashboard and the market information every month. So it's not mandatory that you get it, but if we didn't have them doing it, we'd have to do this in-house, which would mean probably, given where everybody else is at, I'd have to do it. They've obviously got, all of this reporting in the software set up that they just plug the information in. It'll produce those graphs there. I haven't got anything set up with those, any reports set up with those type of graphs. I'd have to build those or get some, reporting software to do it. But it's not compulsory, but it's very useful for you as audit and risk, because the key thing that it's giving you is somebody independent is having a look at our debt position every quarter, running it through their verification software and checking it to our covenants and treasury policy, and giving you the assurance that we're complying with what we should be. We could do it in-house, but I would have thought that, from your point of view, having the independent eyes on it are probably more valuable.
Thank you, Nick.
Yeah, subsequent question. It's right. So yeah, what is the cost of that process, and how often are we actually looking at changing banks or people we're borrowing money from?
The cost of what process?
Of Bancorp's monthly. Now that I know it's monthly, not just a quarterly report.
I'd have to go away and check how much that is exactly. So I'll let you know. Yeah, I'll go away and check exactly how much the agreement is with them. Yep.
Thank you.
Thank you, Nick. And Kate, and then Tim.
Thank you. I just want to compare the table on paragraph 12 and just check that I'm reading this right in light of Councillor Mintham's question. Paragraph 11, you're actually at a rate lower than you had anticipated, and so that's a saving. I think is correct. Paragraph 11, you're saving 0. Yeah. The next one is you've got your interest rate swaps booked out until 2030. Again, I like seeing the range of investments. It covers a lot of bases for me. But when I look at the funding and liquidity on page 16, I can't see that out past 2028. And I'm just wondering, is that because it's a swap as opposed to an actual?
Yeah. So the on page 16, they're only, you can see there's the orange bar, and then there's the 2 grey and 2 blue. They're the loan tranches of $5 million, whereas the swaps are actually completely separate. Yep. So we've got the core lending of 25 million.
Yeah, yeah.
What the swaps do is, if you go to page 17, the swaps are in that top left-hand box. What they do is they bring that green block in, and if you didn't have that green block in there, that effectively our loans would all be accounted for by the blue bit down in the bottom corner, which is below the bottom red line. So if we didn't have the swaps in place, we wouldn't be complying with our treasury policy. We'd have too much debt that was not fixed and didn't have that cover in place. So the swaps move those loans into between the red lines where the green lines are, with what our interest rate cover is going forward. Otherwise, would be exposed, as the blue bars show, would be exposed to just the short-term interest rates.
Yeah, no, that's fine. It's getting my head around how when those are fixed, but it's fine. I had thought that was the difference between the swaps and the actual.
And I think lastly, Tim.
Nick, there's been a bit of discussion lately around the debt that we have, and also the fact that we have a managed fund, and they seem to be sort of similar amounts. I think our core debt is 25 million and the managed funds 28 million. We see here that our cost of funds is 4.96. Here's an opportunity for you to explain why we have debt and we have assets of a similar value. Could you do that for us, please?
Yeah, because they the fundamental reason is that the debt and the managed fund represent different ratepayers. So the managed fund is effectively part of your general rate. So the investment return off that is returned back to offset general rates, whereas our debt is that the core debt is largely due to belongs to targeted ratepayers, which is you predominantly your transport ratepayers and your infrastructure through the flood and drainage ratepayers.
And in terms of return on our managed fund, around about 7.5%. So
yeah, I think
there's
I think that's the next one. I think it was rolling year was like 7.14. Is that what it was?
So there is a margin. So our cost of funds is 4.96, and we're getting a return on our managed fund of about 7.5. So there's an advantage having both. Yep. Okay, I answered the question for you.
Yeah, thank you.
And Gary?
Thank you. So the terms of the lending is quite short because I see the maturity is 2028, 2030. Is there an automatic expectation through LGFA that we would be able to roll those over on similar terms or whatever their terms are at the current time? Or is LGFA lending short term and without the expectation of extension?
Yeah, we when we went into it, effectively we had the 25 million spread over effectively 5 years. So we had one tranche of 5 million was current in the current year, and then each year after that we had a tranche of 5 million maturing. We could have pushed that longer, but at the time that we went into the borrowing, by the time we'd set up and joined the LGFA, when we were first going through that process, the interest rates were really low. They then accelerated, and by the time we drew down our first tranche of debt, the 25 million, two of the loans that we've got there for long-term ones are at 5.7%, which is quite expensive given where they've now dropped down. So we're trying to manage that, and like next year we'll have one of those 5.7s mature. And typically what we're doing is we're just taking each long term that it matures and pushing it out to a new 4-year loan, so that there's always a tranche of 5 million maturing every year. But we could change that. We can borrow long term from the LGFA. We can borrow 10 years. But as with all things, the margin that you borrow at is greater the longer you push out. Now, it might be as where we're getting to, and this is why we'll talk to Bancorp, as rates are dropping and getting probably down towards a relatively, their historic low levels, because they're not going to go back to where they were around COVID. We might look to change from that 5 million per year to push some of it out and take some of it even longer than 4 or 5 years. But we certainly weren't going to do it sort of 2 years ago when we went into this, because rates were, up closer to 6%.
Thank you. And just the other question is just around the liquidity, and almost similar to Tim's question, but going forward long term, is there a need to maintain that level of liquidity at a similar level to our core debt over and above what we would then have as the trading income, say, of rates in versus expenses out?
Yeah, one of the covenants is around liquidity. Which page is it on? So if you looked on page 16, there's liquidity. What we add up there is you can add you basically have to hold cash or cash equivalents, and the managed fund accounts for that. So that liquidity ratio, the first box down, is 135%. It's got to be maintained at more than 110%. Yeah, so effectively for every 100 million of debt that you've got to maintain 10%, so $10 million of liquidity, whether that's cash or in our case, the managed fund is counted as that as well. Yeah, so there is a need to maintain some form of financial asset, regardless of, you can't just have the debt because it's part of our LGFA covenant.
Exactly. So then that creates some impediments around the managed fund and the ability to use it, and that we could quite seriously upset, say, the financial apple cart of our balance sheet.
Yeah.
And our
Yeah.
ability to have that debt.
Yeah, because although like liquidity there, cash, term deposits, managed fund, 54 million. This was at March, so we still had, money. There's periods during the year when we've got a lot more liquidity, but once you get down to June, the cash and term deposits are a lot lower. So if you like, the real, the guarantee that we've got around maintaining liquidity is the managed fund. Now it's currently, like Tim said, 28, I think it's closer to 29 million. But depending on what happens in the market, if there was another COVID, when COVID came along, our managed fund was 24, 25 million, it dropped almost down to 20 million. So, you've got to maintain a bit of headroom there. And the liquidity ratio as well is also done on gross debt. So they do the amount we have to hold liquidity for the port's debt on lending as well, whereas the other ratios we've got is net debt or net interest. So we get to effectively bring back whatever the port is borrowing off us as a financial asset or as interest income. So it's not as big a deal for those other ratios. It is for the liquidity, where we've got $150 million facility with the port, and we've got $25 million ourselves. So effectively, we need to be maintaining, 17.5 million in liquidity for that debt.
Thank you.
Cool. Thank you.
I'm actually just going to do one more short one because I'm just now conscious of time because we've got a few pertinent items to get through today. So just one last one from Kate.
Yeah, sorry, on page 16, the 4.96, which is the cost of funds, you've talked about that being an average because we've got some at 5.11, some below that. How do we do this with Port Otago? What rate do they pay us?
Oh, the Port Otago, we don't count their lending in that 4.96. They pay us exactly, it's a direct pass through.
Yeah.
So whatever has to be paid to LGFA, they just pay that direct. So there's no margin. They're borrowing, they've got their own debt structure set up, they're paying their own, and then it just passes through.
Yeah, and what is that risk spread for them? You talked about so understanding their graph on page 17, as you pointed out to me, that top one, what's the spread like of that?
Well, they've got all of their loans spread over. They've got them actually out over a much longer period than that. They've pushed some of their debt goes out to. They were doing some 8-9 year loans. So they've got similar spread because they operate, as all companies do. They operate under a treasury policy that has the same parameters.
And the oversight over that for us, because it was a risk factor for us, I presume goes through the liaison group, was it?
No, I don't think the liaison group has ever got down into that. I mean, the oversight for that is really you as council when Port presents their half year and definitely their year end outlines all of where all of their there's a whole section on financial instruments, and all of this is outlined in their annual report.
Thank you.
Thank you very much, Nick. So yeah, very pertinent questions and very important for us to understand the debt structure that we have here at the council and how it interacts with other parts of our financing. So can I someone move the report? Okay, thank you. Seconded by Gary. In favour?
Aye.
Next, carried. Thank you for that, Nick. So 9.2 is our managed fund portfolio performance update. you would like to introduce the statement, please.
Yeah, again, standard report. This is the JB Weir quarterly performance report. So we've just had a little bit of discussion about some of the stuff that's in here. Managed fund value at the end of March was just under 29 million, and the rolling 12-month return was 7.41. I thought it was 7.14, but got my 1 and my 4 around the wrong way. So again, the 12-month performance has been good. There was a dip in the March quarter, though. You'll notice it had a negative return for the quarter, but over the rolling 12 months, still a strong return.
Just to remind the subcommittee that it's the next item on the agenda. Just going to talk about the SIPO and the private equity aspect. So for this item on the agenda, it's just around the portfolio performance of the portfolio. If anyone has any questions for Nick on it, Gary.
Nick, does the return incorporate capital appreciation or depreciation as well?
Yep. So the return is a mix of interest, dividends, and capital gain on the equity values, and it's sort of about 50, or maybe a little bit more than 50% is the market movement typically when we budget for it. I think this year's budget we budget for about 1.8 million. About 800,000 of that is interest and dividends, and about 1 million is the expected gain on the value of the equities.
Okay, thanks.
All right, we might move to the next agenda item then. So who would like to move? Tim, seconded by Kate. Thank you. In favour? Against? Carried. 9.3. So a revised statement of investment objectives, policies and objectives. So our SIPO, which we've had some discussions about recently and a workshop as well. So Nick, I'll just get you to introduce it just by reminding us a little bit of the background and then the recommendations that we've got in front of us. Yeah, we can open up for questions.
Yeah. So all of this started off with back late last year. Did an independent review that came to Audit and Risk in December, and then we did a follow-up on that in the March meeting, looking at what the recommendations were. So you as Audit and Risk went through and I've listed in the report there the various things that you considered in March, and you decided to make some changes. Really the only one that needed amendment in the SIPO was changing the split of the fixed interest to be 50-50 New Zealand and overseas. So that's been reflected in the amended SIPO, which is there marked up. But the outstanding item and from March was looking at a private equity allocation, which was one of the recommendations. JB Weir provided some information in March, and we included that in the paper. And the resolution was for them to come back and present to Audit and Risk so that you could look at it in a bit more detail, ask some questions around it. So you did that 2 weeks ago. They presented to Finance Committee, which was a good opportunity because obviously everybody from Audit and Risk plus anybody, other councillors were there as well. So you had that presentation, had the discussion with JB Weir. So now what you've got in front of you is the marked up SIPO with the changes that you agreed in March. And I've highlighted in there sections that may need amending depending on where you want to go with the options that are in front of you with private equity. And we've outlined them there with the independent report from last year recommended in having a 5% private equity inclusion as an asset class, and basically switching that out so that you remove the 5% property allocation that's currently there. So that's one option. If you didn't want to go with that, there's still the option to remove the 5% property allocation and just spread that over the other asset classes, equity asset classes. JB Ware talked about that when they were here. If you have a look, the property allocation, it's only New Zealand listed property. Typically, we're always sort of underweight in it. Currently, it's only sort of at about 3%. There's only 700,000-800,000, whereas a 5% allocation would be closer to 1.4 million. So that would just simplify the portfolio. And the other option is, of course, just to leave the SIPO and the strategic asset allocation where they are. So they are the three options. Depending on what you agree here, we'll finalise that, finalise the SIPO, and it would go to council at the end of this month and for final approval.
Thank you for that overview, Nick. So we'll open up for questions. Just to note that we do have on that recommendation number 3, there is an A, B, or C for adoption today. So when we sort of get to that part, it might be easiest if we are sort of voting on it. But we'll see how that the questions and answers goes to start with. All right. Has anyone got any questions for Nick on this paper? Tim.
Nick, could you just perhaps review the recommendation we had from the independent, well, it was a review, in regards to, from memory, they were suggesting that we need to take a little bit more risk in our managed fund. So that was a report that came through from who?
It was from,
take us through that, please.
Yeah, it was from Ericsson's Global, which is independent, investment advisors. Yeah, they did note that. They said that their view was that, yeah, we could take more risk. But as you've probably seen, there till March, even though we've had a bit of a blip in the market, the way our portfolio is structured, which is 50% growth and 50% income. So you always look at growth as your equity markets, and your income or your defensive is effectively your fixed interest. And when we set up the SIPO, we looked at that. And if you look at the SIPO and the Treasury Management Policy, council's definitely got the capacity to accept more risk. But being a public entity, the view was that we probably don't have the appetite to. And it's probably quarters like we've just had, where markets take a bit of a blip. We're not as exposed as what we would be if we if we'd weighted more towards equity. But definitely something to consider. We haven't really considered it here, other than the potential inclusion of private equity.
And can you take us back to the reason we got that report from Ericsson's? I mean, what was that all about in the first place?
It's one of the terms of, and I can't remember whether it's the Treasury policy or the SIPO, is that the performance of the fund will be reviewed every 3 years. So this was actually the end of last year was the 6-year mark for JB Ware having been in the fund. We did the previous 3 years. Obviously, they'd taken a period of getting set up. So we looked at it then, didn't do an independent review, but now 6 years on, their second 3-year term, we went down this route and did an independent review. But it's actually outlined the review of the performance of the managed fund, and the fund manager is set for a 3-year review. Doesn't necessarily need to be independent. The next one we'll discuss with you as audit and risk. It might be that you just want to look at it in-house, or you could choose to look at it in-house, and then depending on what your view is, you might go independent. But certainly after 6 years, we thought an independent review was probably prudent.
Thank you.
Alexa.
I'd just like us to head back into some discussion about the private equity piece. I don't have a great understanding of private equity, but what I read and what I've read about, it's not always pretty. And hearing Adam's concerns this morning, I'd just like to know how we would mitigate some of at least the appearance of private equity investment.
Yeah, JB, we covered that off. Effectively, private equity is just investing off market. So you're not investing in, the NZX or
Yeah,
Dow
I
Jones
understand.
listed companies.
Mm.
They've got access to, to private companies who aren't listed, and there is plenty of them. JB Ware, they highlighted that if council was to go down this route, they've got a preferred fund, which is the Hamilton Lane Global Private Asset Fund. Now they noted that there is some alignment with our ESG policy, but these funds typically don't, they don't follow the same sort of ESG policy that we do. There would be, if you like, there probably would be instances where investments through a fund like that wouldn't be in compliance with our ESG policy. So if you were to go down that route, then JB Ware had said we'd need to amend the ESG policy to exclude the private equity from it. So that's probably the big part of the discussion is that somewhere that council wants to go, given the time that you'd invested in setting up the ESG policy and where it's at. So you're weighing up, do you want to go down that route, have the exclusion, or are you comfortable just sticking with the existing equity markets and retaining, the direct control that you've got through the existing or the ESG policy that you've got in place?
Can I just have one supplementary? So in that understanding, or my understanding, the private equity markets have far less public scrutiny than the equity markets, right?
Well,
Is that not right?
no, I mean, I think that there's still, something like these private funds still have, they're still controlled and audited, and there's a lot of scrutiny on them.
Is that publicly available scrutiny?
I don't know. It's a simple answer. How much information you've got on exactly, what the actual investments are in, but it's not like the current portfolio where you can see from JB Ware, here's a list of all the companies that we're directly invested in. Effectively, it's probably a bit more like your superannuation fund, where you've got a fund, but do you necessarily know every investment that they've got? They tend to, have percentages of all sorts of bits and pieces. Then you might not know 100% what you're invested in through your superannuation either.
Richard? Yeah, just reflecting, because I know you're away the last few while, I think from the session we had, they were pretty clear if we were to go down this path, we would have to exempt those private equity out of the current restrictions in place on the rest of our portfolio.
I see, yes. Okay, thank you.
Yeah.
Thanks. Was I right understanding though from what JB Ware explained to us that there's still a degree of vetting undertaken, and the exemption needed was as a precautionary measure, because if you actually went delving into some of these companies, they may have associations that just weren't apparent. They wouldn't meet our criteria. But from the onset, it wasn't actually the intention. Will still be some vetting undertaken at the level we would require it at, but it's just they can't ensure that there might not be something. So by and large, they would still be following our ESG.
Well, no, they wouldn't be following our ESG. They're following their own, which are slightly different. There's some alignment, but we might have some things in our ESG that they don't have thresholds and whatever on. But you're right, and in part or largely, JB Ware said that the Hamilton Lane Fund actually did have some good parameters and there was some good alignment, but there definitely, there could definitely be potential that things would be outside of our thresholds. And then part of the issue is once you identify that, I think what JB Weir said, it's not as simple to divest yourself and get out of that as it is when, as we saw, would have been 3 months ago when we looked at that, JB Weir realised that one of the thresholds had been breached on one of the companies, that they could just divest themselves of that sort of, within days.
Yeah.
It's not quite that simple with this type of fund.
Because you're locked into the investment, and so it's a precautionary measure.
Yeah.
If that was found. Okay, thank you.
Kevin?
I was just, if you're finished questions, I was happy to move.
I'll just check around the table in terms of questions for Nick on this. Yep, we do.
Moving.
No, we've got another question. Another question. Oh, will be Debbie.
Just a quick question from me. I think, JB, when we were talking about this private equity stuff, they were suggesting that if we were to go not to choose the private equity pathway, the money might be better put into overseas equities. So,
No,
I think the recommendation here is to split it evenly.
right, the recommendation is to, for option B is to remove the 5% property allocation and spread that 5% evenly over the other 3 equity classes. Currently, those equity classes are all, there's 15% allocation in each of them. So effectively, like I've done it, I've just rounded it up. They'll now be at 17% each.
I'm pretty sure in the JB presentation on online was suggesting that perhaps they would move it all into one category as opposed to splitting the cost.
Taking that property part idea.
Yeah, it's putting it all into one of the other ones, rather than splitting people. I'm pretty sure the second one.
You said equity classes.
No, wrong. From my recollection of when they presented, they said they just spread it evenly, and that was certainly the discussions I'd had with them. Yeah. But I mean, if you had a different view, if you really want, you could go no, remove. I suppose there's a B1 is remove it and put the 5% into international if that's where you prefer it to be.
It's just when I was reading it, I was reading it saying, well, the guy was saying put it all into international equities. I'm sure because that must have been our higher returning area.
Well, it depends. There's times when international is higher. That's the thing. That's the beauty of having the spread of the 3 is that although they're equity markets, they largely, when there's a significant event like COVID, they'll all drop. But there are times where, international has had better returns and worse returns than the New Zealand markets, which aren't as, susceptible to some of the stuff that's been occurring recently with, events in the US.
What I got from that presentation was I think what you're saying is not debate, it's just I'm sure that's what I see what's put all into one another through.
Okay. Thanks, Lloyd. I think we'll see if there's okay, Tim.
Yeah, just to clarify the motion, we've got A, B, and C or D. Is that the way it is?
A, B, or C. So the way that Nick's so the paper is recommending that we endorse one of 3 options. So make sure everyone understands that. So the first one is the inclusion of a 5% private equity. It's probably the most important point for that. And the other 2 are not doing private equity, they're doing something else. The second one's moving it to property asset allocation across the other 3. Or the third one is just no change at all. So in my mind, I'm going to ask the question around private equity first in terms of, so I think that's a nice sort of clear. Keep this trend.
Kevin's going to move something.
Go.
Yeah. 1, 2, 3, A, B, or C.
Yeah.
Okay.
And move 4 as well. And then that just gets debated in motion.
All right. That's fine. Yeah.
So just to be clear,
No.
we-
Okay, so if Kevin wants to move, yeah, that's fine, so Kevin would like to move.
Yep.
Kevin wants to move.
I want to move 1, 2. Can I just do it, and then you'll understand what I've done, and then you can ask. I think you can ask questions, but then I'll get a seconder, and we'll go through the process. So I'm going to move 1, 2, and 3B, and 4.
1, 2, 3, B. Okay.
I need a seconder for that.
Maybe read out 3B just.
3B is removal. So the only change will be the removal of the 5% asset allocation and reallocation of this allocation evenly across the 3 equity allocations, which actually doesn't quite work because we've got 3. Just a wee technical issue was there's 3 17s, which you'd anticipate that you'd have 16, 17, 17.
All right, so that's been moved by Kevin.
Yeah, just to be clear, the reason I've done that's just rounded. It'll
Yeah,
be
that's what-
16.66 on each, but just done it at 17. Yeah, so
Yeah, no, that's it.
Right, seconder.
Well, we've,
Yes.
that's same except for 3C.
Okay,
Yeah,
so
it
that's, so
I'll
it's,
second it.
yep, Richard will second. Okay. All right, so now we'll, yep, into the debate.
Oh, there's a question, so.
You're going to talk loudly, please. That's a nice background.
Yeah, it's, I can hear the workers outside, but I was just wondering the 3 classes that it's being spread across. Those, could you remind me what those 3 are, or just confirm that one of them isn't the private equity one?
no, the 3, it's not private equity. Those 3 are the existing 3 equity classes, which is New Zealand, Australia, and international.
Yeah, cool. Okay, thanks.
Open debate. Yep, Kate.
Look, I understand, and sorry, Elliot, if you look at paragraph 21, it shows you the A and B of the choices in there easily. The reason I'm happy with where we're at, taking out New Zealand property may be the right thing if we wanted, and I understand where that come from as being more aggressive. But I think we're also a local government, and we should be investing in New Zealand. I think that gives us a better spreading, especially given where the world is going at the moment. So I'm really comfortable that we invest in New Zealand property, and that obviously it was the category they were suggesting taking us out. I also think it's a long time to be divesting of New Zealand property because it's quite low market. So that's why, again, I'm comfortable continuing with that at the moment, so we sort of the sensible time. So that's the choices that we had, and I'm comfortable saying we've done well in the past. And
Okay, Gary.
I think we all like to vote for this. I think C is the worst of 3 options. I would be voting for A. With B as a fallback option,
Just to clarify, this is B. This B. B has been moved.
B has been.
I see, I said
So
six.
I thought B was A.
So can I just clarify? So Kevin has moved 1, 2, 3B and 4, and Gretchen has seconded, so we're debating 3B.
Oh, sorry.
Sorry.
I thought it failed,
I thought it
No,
didn't
no,
get seconded.
Gretchen seconded.
but I thought it failed for lack of a second.
Oh,
I
sorry.
Gretchen seconded.
Oh,
Sorry, but that was.
I thought C was moved. Oh,
No,
right,
yeah,
sorry.
sorry, yeah.
So Kate and I were both in La La
Yeah.
Land.
I know, it's just that start button, just
Gretchen, yeah.
It's very hard to concentrate.
Right.
Kevin gets to speak first if he wants.
I know, I'll say that.
Alan, would you like to speak?
Yes, thank you. And I understand 3B is what we're talking about and the other one's there. Look, I'm entirely in agreement with the decision not to go with private equity. I think that's really important. Back in September 2023, this council this committee recommended adopting the current responsible investment policy as part of the side vote, and that was subsequently approved by the council in October 2023. At that point, we gave extensive thought to that ethical investment issue, and the fundamentals have not changed. We know that entering into private equity would change that and would cut that down. We know also that JB Ware have offered the alternative method of enhancing our portfolio, and that's in the 3B there. I do recall also part of the argument for moving out of the property is that because of our ownership of Port Otago, we also have a heavy weighting in the property through that way. So I'm very pleased that though I'm not a member of this committee, that we have moved to go for 3B, though I could live with 3C as well. Thank you.
Thank you. Alexa? Yeah.
I agree with that. Thank you, Alan. I am unhappy with any investment in private equity. I don't believe, despite it says that they are subject to the same level, no, you haven't said that, of regulatory oversight as publicly traded companies, and the transparency and information is limited, which I don't think is right for a, with the sort of openness and transparency we aspire to at this council, and we have worked very hard on getting our parameters right for ESG. So do not support in any way, shape or form that. I agree with getting out of property, again, for those reasons that we're already heavily invested there through Port Otago. So it seems to me a bit unbalanced to continue on with that level of property investment. And finally, I just want to throw into people's minds that why is that 5%? It's a rhetorical question. Why is that 5% not investing in our environment, and what might it return if it did? Can we just think of that for the next time we start thinking about our ESG policies? But so I'll be supporting the motion. Thank you, Kevin.
Alexa? Lloyd?
Yeah, thank you. My take on it, I think we get these people come and talk to us, and they're like experts in their field, and they, and we use them they inform us as to what they think they should do. So JB Ware informed us that they thought it would be a good idea to go into a private equity investment, which is all very well. But having said that, when they were making the report, they did reflect around the ethical investment and inability to manage the investments, ethical investments in the private sector. They were very clear that the next option was to divest of the property investment into the other investments. Whether it be one or all three is probably irrelevant, but all three is a good system because it just keeps everything even. So I'm probably in favour of that. So I think it's important that we listen to them. We already have significant investment in property via the port, as everybody says. But in reality, for me, it's actually picking the right person to get advice from and then acting on their advice. And so I'd be in favour of the motion as it's been put. Although I'm not a member of the committee.
Thank you, Lloyd. And Gary, I'll just use my discretion to let you talk again because
Because I'm now talking to
to the right one.
I'm not wasn't. That's very generous of you, Chair. I'm against the motion, as I was before, for slightly different reasons. I think that we as councillors, and certainly sitting around this committee, we have a responsibility to our ratepayers to get the best possible return we can, and we are sitting with some sound and professional advice around other councils also looking at private equity and other government funds also using private equity. It is tested around New Zealand, and there are real concerns out there about what it is costing to run councils and the return available to ratepayers on our investments. When it comes to property, we are very lucky to have the port heavily invested in property, and also we put a lot of effort into the professional directors to operate the port, and we give them a lot of license to do some out there property developments that others might not be quite so comfortable to do, and we get a substantial return from that. So we're heavily invested in property. for the right reasons with the right professional experience sitting around that. And I think whatever else is out there in New Zealand property, as JB Ware was saying, is performing quite poorly. So it does make sense for us not to be in property. But my preference would be private equity for just a very small percentage, purely because we need to be doing the best for our ratepayers with our investments.
Thank you, Gary. Tim.
Thank you. Yeah, I'm against this motion too, but on principle, we were talking principles here. The principle that I am basing this decision on is that there is a lack of good capital investment in private equity in New Zealand. It's very hard to find. It is good that funds are now looking at supporting innovation through private equity investment. The markets are very tight in their regulations, and it excludes quite a lot of companies from actually accessing capital. So that's one of the reasons. The other thing is, yes, I do agree with moving out of capital, out of property. The property investment is based on capital returns and speculation on capital growth, and inadvertently that has an effect on pushing prices up of property all round. And first home buyers, for instance, are disadvantaged by people investing in property. So all in all, we're not talking about a lot of money. It's about $800,000 to $900,000 that we want to put into private equity. It's not huge. And I'd just like to remind the council that we did invest $2 million in the environmental fund from reserves just last week. Thank you.
Thank you, Tim. All right, and Kevin, at the end.
Yeah, but I'm very comfortable with this position. We've had very good advice from our reviewer and also our fund managers, JB Ware. I'm comfortable with this. If you want to invest in property, you in New Zealand, you simply set up a committee and go and invest it. You don't invest in, and that's the best way you can control it. And we're probably not in that space to do that. So I'm very happy to invest. We have the port, which is it's close to $1 billion in property in New Zealand. So that's our property vehicle and doing very well. And we've got 3 good conservative funds that we're part of, which reflects generally the appeal of our target people. So I'm very happy to move with B.
So now we will vote. I'm going to go through each one. So recommendation 1 is to note this report. So I'll vote on that one and then 2, and then we'll vote on 3, B. So we just have it nice and clear going through each one. That makes sense. Right. So, all right. So those in favour of number 1, note this report. Aye. Against. Carried. Those in favour of number 2 to approve the changes to the priced SIPO. Aye. Against. Carried. And so for 3B, so those in favour, and I'll just remind, so it's just the committee members can vote, ex officio can vote.
We have a division.
As well. Yeah. Division. Just check. So for this one,
Councillor Forbes? Aye. Yes.
That's
right. Voted for the removal of 5%. Have enough B.
Forbes is yes.
Councillor Callagher.
Against.
Councillor Malcolm.
For.
Councillor Newtham.
Against.
Councillor Robertson. What? Councillor Wilson.
Yes.
Chair Douglas.
Yes.
In favour and 2 against. Motion is passed.
Just to repeat that, so 5 in favour, 2 against. Motion is passed.
That's correct.
And now we are on point 4.
Mr. Grimes is still thinking about.
So 4 is to just note the based on the audit risk subcommittee direction, the final price side voting will be presented to council on the 25th of June. So those in favour, for, against, carried. Right, thank you very much, Nick. I appreciate the time you've spent on this debate. And as we know, recommendation will go to council for approval on the 25th of June. Next item on the agenda. 9.4 is our annual report timetable and matters under consideration for the annual report process. Welcome, Sarah.
Thank you. I hope that you can hear me. I have been struggling to hear you guys. So this is just our annual report timetable, and included in here are any changes that we expect for the annual report from financial standards. So if I just quickly go over the timetable, we're planning on presenting this to the Audit and Risk Subcommittee, the draft annual report, on the 17th of September, and that would then go to council for finalisation on the 25th of September. So that's the timetable of the annual report for this year. It is slightly earlier by a couple of weeks, kind of half a month than the prior year. That is really just to have it adopted and signed before we go into local government elections. The other part of the paper outlines the changes to the accounting standards. So if you guys are comfortable, I can just run through those briefly for you. Perfect. So there isn't actually any changes that we're expecting in the accounting standards this year, but there's been changes in both council with the interest rate swaps that you've heard earlier in Nick's papers, and also Port Otago with some joint ventures and a new subsidiary that they've got that will need to be put into the annual report. So last year we did actually have an interest rate swap, but it was signed at the 29th of June. It was at market value, so it wasn't actually disclosed fully as needing a full table and needing to be at market value because it was signed right on year end. This year we will need to put that disclosure into the annual report. It'll go into the financial instrument disclosure section, and I have put an example of the table that's in paragraph 23 of I'm not going to say it looks exactly like that, but that should be kind of an idea of what the disclosure would be that we'd be putting in the annual report to show the fair value of that interest rate swap. Is there any questions on that before I move on to ports?
Sarah, just some clarification around the joint ventures Port Otago. Are we talking about the Dines partnership?
Sure.
And
We'll just cover a question on the interest rate swap first, if that's right. So that was so just on the interest rate swap table, to see the fair value there, you've got a notional value and a fair value, and just the difference between the two numbers would be, so one says so it's 4 million.
Oh, these are just fake numbers. No, sorry. This is just an example disclosure. It is not at all our, sorry, I should have clarified that. It is not at all our interest rate swap. This is just an example disclosure table that I took from a standard example of what I'd be planning on putting in the annual report. Okay. My apologies with that. I should have made that clearer.
That's fine. Any other questions on the interest rate swap disclosure? No, that's fine. Sarah, thank you. Next.
So if I move into the what you were asking about with in relation to the group, so Port Otago, so they have a 50% joint venture that they've entered into with Giants Transport. I think it's colloquially called the Mosgiel, in a container area. So it actually does have a name. It's the Southern Link Property Limited is what the company's called. Due to that being 50% owned, at the moment we would be looking at having that as a joint venture. We haven't had the disclosure for a joint venture in our annual report since June 2021. So there used to be joint ventures that Port had. They actually bought the rest of the shareholding and it became a full subsidiary that was consolidated fully into the account. So that's why the disclosure got removed. So it will just be adding something back. Well, it will be very similar to what was in the June 2021 report around what the holding is, and then obviously having that as a balance sheet line equity accounted.
Oh, can I just ask a question on that now?
Yes.
Just, so in terms of what the impact on our financials would be, is it just some additional equity, so additional line of equity? Is there any other sort of impact or flow-ons that we need to consider?
No, so it'll just be accounting policy that isn't in there for joint ventures, and just adding in the line into our balance sheet for the company, the 50% share.
Yeah, so no impact on covenants or anything else that we're sort of perhaps affect anything else.
Sorry, I missed the first.
No impact on covenants or anything else?
No, it's not intended that there'll be any impact on anything there.
Gary?
So any exposure or risk sitting with either of those joint ventures, is that going to be limited to the liability of the new companies the board's establishing, or does it sit
At the moment,
board level, or does it fly right through us?
At the moment, we haven't been told of any risk. I mean, obviously, when you make your accounts, you do go through and look at any contingent liabilities or anything like that you have in relation to your main entity, Port, as well as anyone else in the group. At the moment, we haven't been told about anything like that. Port hasn't told us that there'll be anything.
You've got to, this is just the disclosure in the group accounts. Yeah, but we're obviously, we're 100% shareholders, so any risk of whatever happens in those JVs sits with Port and doesn't flow through to us, other than any impact that it might have on the value of our shareholding. But there's no direct liability or risk that flows through to us.
Right, but noting that certainly one of them is quite a substantial project and it has some ways to go and level of risks to achieve completion. So what you're saying is that the risk would not sit with us, it would sit with Port.
Yeah, yeah, absolutely.
Thank you.
I'm going to ask everyone to move their microphones a little bit closer to them. When that noise starts, it's hard to hear. Kevin?
Yeah, look, it is a concern of mine that we have, and look, both projects I'm excited about really, and I understand the rationale behind them and the work behind them, but if our fully owned company is going to joint ventures with people, where is the process for us to say, actually, as the owner, we're comfortable that is signed off, or we have approved that? And I realise that it's a separate company, but it does, if the Port did go bang tomorrow, would we not have to?
So can I just we're talking about the annual report timetable here. We're not talking about our relationship with the Port and how we manage their commercial decisions. I think that is well outside the scope of this paper, is my advice. I understand that there will be opinions on the decisions that Port are making, and absolutely is 100% shareholder through the relationship that you have as councillors with the board. You can have those conversations, but my advice would be that that's well outside the scope of the annual report timetable, which is the purpose of this paper. But I am happy to take an action away to enable you to initiate those conversations outside of this paper.
Thank you.
Yeah. So I guess, any questions around the so this is going to be some new disclosures in our financial report. Any sort of
the second joint venture is 70% owned, so we are expecting to just actually consolidate that into the group, the Port Otago group figures, and then there'll be a minority shareholding line that will get removed from equity. So that is similar to what we have done in previous years, exactly like the joint ventures when there are companies that are not 100% owned by the group.
Happy to move.
Second.
In favour?
Aye.
Against? Carried. Thank you very much, Sarah. Item number 9.5, our safety and wellbeing report.
Page 87.
Welcome team. I'm going to as each of you are talking, if you could make sure the microphone's directly in front, just because of that, I'm sure that noise will start up again. But thank you very much for another thorough report. If you'd like to just provide a brief overview to introduce the paper, that'd be great. We can open up for questions.
Sure. Kia ora koutou. It's good to be here again to talk about all things people and safety at the ORC. Shortly we'll take your questions, but it was just a few things we wanted to note. You may have noticed a new risk and hazard summary section in the report, and that's introduced to try and be transparent around the risks at ORC and what we're doing to address those risks. Also wanted to mention that work continues on revised lead and lag indicators. We had hoped to have it in this report, but didn't make it, so we hope to have a revamped report for next time. And also wanted to say a special thank you again to Councillor Somerville for attending the quarterly new staff induction session. Your passion for the work of ORC was evident and greatly received, and another successful new starters event from our perspective. And Gina just also had a couple of things she wanted to mention as well.
Yeah, cool. Hi everyone, nice to be back. I haven't. Good reminder, thank you. Hi everyone, nice to be back speaking to you again. There was just a couple of things that I wanted to note since the last time I've been here. One of them being that the health and safety team are now really engaged in our regional health and safety special interest group. So that is a group of regional councils across New Zealand that get together to collaborate on different safety initiatives. So one of those key ones is the contractor working group. So we're expecting some really awesome things to come out of that. And I am lucky enough to be the co-chair. So yeah, comparison data going forward, we'll be able to baseline ourselves against those other councils. One other thing I just wanted to touch on is that there is a new How to Stay Safe guide, which has been released by Local Government New Zealand, and it's directed at elected members and those seeking election as well. So all around looking after yourself online and any in-person engagements that you might do as well. So that is stored in Diligent, and highly recommend that you all have a look at it. Thanks.
Thank you, Gina. Thank you, Mark. Open the floor to questions. Okay.
Thank you. I'm going to concentrate on, thank you for, there's a lot of stuff in wellness and everything here, but I'm going to get to the, what I think is the nitty gritty bit is paragraph 30, which is the work for snapshot of information. The annual staff turnover 12.3, that's substantially down, is that, in the last 5 years?
Back in June, July, when Richard started at CE and I started my role, it was probably about double that. So it has come down. It's been fairly steady at about 12% for 6 months or so.
Yeah, I'm interested in, I mean, having that context would be helpful over duration because it helps. But then I'm also interested in what the I don't want to say industry, I suppose local government averages are for some of these things, because the ensuring that we aren't, yeah, I mean, I was quite interested in the average tenure is 4.7, and what's driving that, and what the, do we do exit interviews for everyone?
Yeah, we do. Yeah.
So what's driving the 4.7? Is it that people come here to training as new grads and do their experience and then move on, or is it
so just to clarify your question, why we're losing staff?
Yeah, well, yeah, the tenure is in some areas it's very long. I mean, I can name quite a few staff who've been a long time, and presumably that's why. So later on we've got investment into long-term tenure, and I'm just nutting out why we're still, why that is there, which presumably is because we've got a short tenure and that the investment is better for the longer tenure, and just understanding why the tenure is 4.7.
Yeah, so we do have many staff who are absolutely passionate about the work and do end up staying with us for a long time. We also have graduates who might stay with us for 2 or 3 years and then move on for career progression, and the challenge for us is to make sure we're still competitive, that we have the career pathways and opportunities, that they see a future to stay with us. So that's a big part of the people strategy is trying to create the conditions for everyone to be happy and engaged and have a long future with ORC.
Can I just check something? Page 70's got the long-term trends on turnover, if you're interested in that. And also on the average tenure 4.7, that includes all of our current staff, and obviously we have grown significantly in the last 3 to 4 to 5 years, probably in my time here. So a lot of those, or all of those increases, obviously are people that can only have been here for 3 or 4 years, which is driving the average down. So we still have, I mean, in my experience, I think the workforce is shifting in terms of the people, in terms of that historical thing where people will stay in a role or an organisation for, you know, decade, 2 decades. We still have a number of staff within ORC who are long-serving staff members and who you know, we rely on in terms of experience. And I still think we also have a good number that join our workforce with the intention of being here long-term. I think this average tenure is driven a lot by the growth and the fact we have hired so many new staff in relatively recent years.
So, yeah, and sorry, this is page 70, I don't know how, but something to do with quantum papers for history. But the no, sorry, where I'll get to is page 95, but I'll ask some questions about that and the mechanisms you've got in that part of the report that I just want to check some of that stuff.
We did also recently lose our only 50-year employee, so that's bringing down the average.
Yeah.
Retirement. It wasn't anything more tragic.
Older than the industry, the organisation.
All right, Tim.
Look, I've got a question just around the drug and alcohol policy, which looks like it's to be implemented in July next month. Can you give us a bit of a sort of a summary of what that policy is? Is there random testing in it? How do you police it?
So since the last meeting, we engaged with the ELT to inform overall policy direction, including sharing what other councils are doing in a risk assessment. So that was a key basis for the design of the policy, and engaged with the health and safety reps and now we're out to staff consultation. The policy doesn't include pre-employment or random testing, but has post-incident and reasonable cause testing. So in terms of implementation from July, initial training and guidance to staff and contractors, training our people leaders and health and safety reps on what to look out for, and just keeping it alive and in front of mind. But we're not seeing significant risks there, and we don't envisage doing a lot of testing, but it's just an important area of health and safety that we need to have in place.
So when would you do testing?
So post-incident, if there's a serious safety event, such as a notifiable incident to work safe, significant property or vehicle damage, a near miss that had the potential to cause serious harm, and where we believe the workers' actions or inactions could have been a contributory factor, or reasonable cause where the employee is showing a number of signs and symptoms that might indicate they're impaired.
Gary.
Thank you. A wee few questions just on, so item 13, we had a rollover. Was that on private property or was that on a public road? I assume a vehicle rollover when we say a rollover?
Yeah, I can answer that one. So it's a combination of both. So from a public road into private property.
Right. So it wasn't undertaking an action on private property, it was a roll off a road.
Correct.
Right.
Yeah.
Yeah. And I guess hopefully there wasn't an injury or there wasn't a
very minor injury. Yeah.
Right. Right. Okay, that's cool. Thank you. What would be if it was on private property? So if we were in conducting our business, either warranted or not, what would be the liability if that happened in a private property? would it sit with the landowner or sit with the council?
It would still sit with the council, it's still a workplace, so that our legal obligations wouldn't change. I mean, in that case, it was a contractor and it was a serious incident, so there was extensive investigation and ongoing discussion with the contractors regarding learnings and number of corrective actions they've taken as a result.
Right. Okay, cool. Thank you. Under number 18, we do the list there of things, training that has been done. We've done four-wheel drive training for 20 employees, because I guess we have four-wheel drives. We've done river safety training. We've done side-by-side training, because I see us towing side-by-sides, but we've done tractor operation training for 8 employees. Why would we do that?
So there are some areas of the business that operate tractors for flood banks. So they do mowing activities and maintenance of those flood banks. So it's a very limited subset of staff, but yes, we've trained them to ensure that because it is a flood bank, it's got high point to low points, that we wanted them appropriately trained so that they're doing that in a safe manner. But yeah.
So the reason that we went through a full set of training for staff more recently is that we recently replaced a much older tractor unit on the Luther scheme with a newer model, and it was time to update it. So we just went through the process and bunched them up and put it together.
Oh, never realised we had a tractor. Not saying I want to borrow it. One other quick question, and please don't think this sounds kitty, but under the wellbeing program document that's there, there's a mention about a social club, which is great. But I just, in reading the description of the social club, is that funded by the ratepayers or funded by the members of the social club?
So it is funded by members of the social club. So staff members will opt to be a member of the social club, and from there essentially allow a deduction to come off each pay. Yeah, so funded purely by staff for the activities and undertaking.
Right. Yeah, no, it's just as it explains, with costs covered for members. And so I just want to clarify that. So, no, that's cool. Thank you.
I'm just going to, I'll ask my question then if you Lloyd. Just keen to understand, so you've got a very big work program. A lot of activity going on, whether that's training or reviewing different areas and keeping up with risks and the likes. Just very keen to hear how you manage that, and I guess manage your sort of timelines and what you can achieve, realistically achieve in certain sort of timelines. So that overall approach to how you are managing your workload.
Good question. It is a constant juggling act. We're overly ambitious often in what we set out to achieve and think we can achieve in a year. So regularly reviewing priorities and adjusting and parking certain things to make sure we can concentrate on what we need to is a big part of it. We do outsource things from time to time, but that still has worked for us in terms of reviewing what they submit and making sure it's tailored to our context. But yeah, it is a constant juggling act. Often we find that to do things well, engaging with staff to get their input can mean that things take longer than we'd like, but better outcome through doing that. Not sure if that answers your question or not.
Yeah, and I do recall you had a lobbying sort of strategy, maybe it was a 3-year sort of plan. Is that sort of in terms of keeping that up to date or keeping an eye on that and progress against it?
Yeah, that's still an ongoing focus, and something Gina's introduced this year is using a tool called Asana, which it's a digital planning and tracking and review tool that's helping us to keep a close eye on that. And she's also put a project update page on Te Aki, so that's a bit of transparency for staff and holding us accountable as well. Anything you want to add to that, Gina?
I think you're coming well.
Lloyd.
Oh, fine, thanks. Thank you.
And Kate.
Sorry, it was 87, not 97, my question. The long service and additional leave, Is that added on to people's remuneration?
Not
For accounting purposes,
So the additional long service leave and
the KiwiSaver contribution.
KiwiSaver. Effectively, the KiwiSaver forms part of their total remuneration package, so it is on top of their salary. Additional leave is not. It's just provided for under policy.
Okay, and how many of these are embedded in any collective accord with staff, or are they flexible things that can be come and go as policy?
Good question. Do you recall that, Kelly?
Yes, so the long service leave is part of the collective employment agreement. The KiwiSaver 5% is obviously it's kicking in this year, that's how collective, and the there isn't. It's all covered in policy. Yeah.
So the 6%, which is the long service.
Yeah, that's covered by policy. I don't believe that's in the collective.
And so if government changes policy as they have with KiwiSaver, does that automatically go up, or was that being just reviewed?
No, it's outside of we acknowledge that this incorporates the minimum set by government, so it doesn't need to adjust to the government amount at all.
Thank you.
Thank you very much. Can I have a mover, please? Tim. Seconded by Eric. In favour? Against? Carried. Thank you very much, team. Appreciate your time. All the good work that you're doing. Good up. Thank you. All right, item number 9.6, which is the last on this topic agenda. Our corporate policy overview. Amy.
Thank you, Chair. I'm pleased to present this report. It provides a high-level overview of the corporate policies currently in place at ORC. So we maintain a master policy register here, and it includes 48 corporate policies and 17 council or governance policies. They're all aligned with our strategic objectives and operational needs. Corporate policy updates and reviews completed last year incorporated our refreshed staff values of mana tika and aroha. They also reflected changes in legislation and updated policy ownership related to the ELT restructure. Several of the ORC governance policies were updated and approved as part of the long-term plan process last year. This work is part of our ongoing commitment to maintain a robust and transparent policy framework that supports good governance and risk management. I'm happy to take questions.
Tammy, just it relates a little bit to the 6% KiwiSaver. I notice that you've got a policy, superannuation schemes policy, and you've got 3 separate schemes in that one. Page 96 of the intelligent. Are all of those subject to the same rules around long service leave up to 3 years and 6% KiwiSaver? Or
in terms of long service leave, so that's outside of scope of this particular policy. In terms of contributions, my understanding is that it's the contribution amount, so it would be 6% going to whichever of those schemes.
Yeah, it probably wasn't a relevant question because we're talking about policy, not the content of the policy. But anyway, that's fine.
And Kate?
Thank you. Look, I appreciate and congratulate the team on the reduction in staff turnover, which can be many reasons for that. And so I appreciate we embed some things to ensure long employment, but I'm really concerned about the long-term cost of some of those policies and where, because they can be costly if you add them all up. And I'm just wondering at what level governance gets involved at that setting or not for those policies and the heads up about them. Because when you add in things like sickness leave, food and those sort of things, I just want to understand at what point we get involved in those
So their operational to the staff management, the governance oversight comes through the setting of budgets and how you enable, I guess, me as the employer to fund our staff costs. And then we need to obviously consider the benefits package as part of that and balance retention and along with the overall cost. So they're all, as we said before, the KiwiSaver is included as a part of the salary package and is picked up in those reports that come through in terms of staff costs. So that the policies itself are set by ELT and approved by me, but the governance oversight certainly comes into the overall setting of budget expectations for staff costs for the organisation.
And it's an area that's really interesting because I totally get where we may be setting some of those things at a time and place. Maybe it's a question for you, Richard. It's understanding the longevity of some of those commitments when the circumstances can change, and our ability to come back from some of those steps is difficult because it doesn't just affect one annual plan. And as I think many of us have commented, we don't quite see those costs and the implications long term because we haven't got that work program that shows those sort of things. So I'm just wondering at what point do we whether there can be more clarity on how that is done in those long term what we're booking in really as costs that I don't think we always have that headsight on.
So I would just refer again to the staff cost set through because that is effectively your long-term view of what we're investing in staff, whether it be through a KiwiSaver contribution or a direct salary or overheads or that. So those conversations are happening at that level. What we do know in local government, and we saw it a few years ago when central government was significantly increasing staff numbers, is we can't compete on a salary by salary basis. And we saw that through attrition of staff, and that was felt right across the sector. So we're trying to consider the total employment package in ways in which we can be less susceptible to those fluctuations in the market and retain a good core of our talented and experienced staff. And on balance, we feel this is one way we can do that. We still need to remain very conscious of our overall budget footprint. And we do think about that very carefully when we are considering these policies, but ultimately your direction comes through the long-term plan and the budget that you provide me to fund our staff.
Thank you. Richard and Kevin.
I suppose just subsequent to that, where we see the KiwiSaver, for example, that's now effective for the July 2026. So that's already in train and being put in contracts now. So we don't actually get to see that, and it's already in contract. I'm not saying I'm against that, but so I don't have an effect. I don't see the monetary effect of that policy, and it's already put in place.
You don't see the monetary effect of that individual policy. No, that's correct. Yeah, so you still see the overall cost of our staff.
Yeah. Yes.
But you don't, you're right, you're correct.
Yeah.
You don't see that on an individual policy by policy basis. We need to manage it within the parameters that you give us for staff.
Yep. Thank you.
So Kevin, I was going to ask, so quite a comprehensive list here, and that's just the nature of the beast in terms of policies, both at the governance level and at that management level. Just in terms of, there's a number with the status of review underway. So just wondering around sort of expected due dates, and I'd like to just, I guess, how you're managing this, because it is, each policy could take quite a while, and some could be quite in depth to review. So just keen to hear how this is being managed at your end.
Yeah, it's a good question. So review underway means that it could be at the initial review scoping in terms of best practice. Has legislation changed that kind of policy development stage to consultation? Most of those policies that have review underway are in the consultation cycle, I guess, of the policy development. So there is a lot of reviews underway. But it is managed within work programs. and based on a risk assessment, I guess, in terms of do we need to review the policy? Traditionally, we had review timeframes annually, and we are shifting that out so that it would the ordinary timeframe is 3 years unless legislation changes or something changes in which we would need to review.
Just a reminder, I know when we get a big list of policies, it's quite easy to want to know some details around some of them, but I guess ours is around that overall oversight of the process of review, making sure they are. So just a reminder. We'll go Lloyd and then Kevin.
Because I saw that as well, but I was just wondering, would it be advantageous or not to have like you got last reviewed and have a date of expected next review? Would that be too much information?
We do have that in the register. It just wasn't included as part of this paper, but yes, we do have that information.
Kevin?
Yeah, page 93, and I'm just trying to ascertain why you've got a trespass policy at the bottom, and then over onto page 94, we've got a code of conduct policy, which seems to be exactly the same wording.
You're correct. That's that there's an error there. Yeah. Yeah. So the trespass policy on page 93 is accurate in terms of the description. The code of conduct description is incorrect.
Oh, okay, cool. That's all right. So you're rid of that. And then just going down further on that page, so we had a COVID-19 vaccination policy. In light of that, have we reviewed, and I see we're going to be removed, decommissioned, but what thought have we done on a policy should that type of event happen again? So we're going to completely decommission it, or are we going to have thoughts on that a similar type of event happen?
At this point, we haven't formally considered the removal or decommissioning. So at that point, in terms of if we were to remove it, we would consider whether or not something more general is required. But in saying that, given our previous experience, given circumstances, we are able to develop policies quite quickly when required and respond. But it would be certainly something to be considered whether something a bit more general would be appropriate to be retained if this COVID-19 vaccination policy is removed.
Thanks, Tammy. Thank you.
Moved by Kate, seconded. By Gary, in favour?
Aye.
Against? Carried. Thank you very much, Tammy. Appreciate it. We've got resolution to exclude the public. Happy to moved by Kate. So let the public be excluded from the following items under the employment, the minutes, insurance renewals, insurance disclosures, the audit plan, and the managed fund report. Moved by Kate, seconded by